Hello, I'm Tara Weber. Welcome to Market Call. Today on the show, we have Kim Bolton. He's president and portfolio manager with Black Swan Dexteritas, and he's going to be taking your questions this entire hour on technology stocks. So get those calls in. That phone number, 1-855-326-6266. And you can also send your question by email to marketcall@bnnbloomberg.ca. Welcome to the show, Kim. And you know, one of the things I was noticing here is that you were saying you're seeing glimmers of hope in the stock market over the next 6 months. What makes you say that?
Pleasure to be with you again, Tara. Well, a couple of things. Historically, ever since World War II, every time we had a calendar year gain of 20% or more, like last year in 2021, the market then fell double digits in the first half of the following year. And in the second half of that year, the markets have returned to at least break even by the end of the year, every time. And I guess the second thing that gives us some hope that we can get back into a bullish routine is, for us, we believe inflation's impact on the stock market and this year's interest rates increases have already been significantly priced in by investors. So by the winter, spring of next year of 2023, the developed world economies could experience a relief rally if investors start to convince themselves that the Fed may have to dial back their aggressiveness so as to prevent that deep recession. Remember that stock markets tend to look 6 to 12 months ahead in terms of valuation, which means it acts as a forward indicator. So today's markets reflect the economic environment for the spring of 2023, which should be significantly more optimistic than today. And the last thing I'll say is the one that needs to lead the charge here is going to be the technology sector because it is the largest sector. So look for the tech side to get a little more robust as we go into the second half of this year.
I was going to ask you about the technology stocks because, of course, that's your focus, and it's an area that's really taken it on the chin. But when we look at technology stocks from semiconductors to software, is there a particular area that you think will be especially one to watch?
That is a great question. Tara, it's interesting because, I don't know, it's like every 10 years, there's a swing of the pendulum between hardware and software. And I know that's sort of broad, but certainly for the last from 2010, 11 till 2021, the horses that led the race were the software side. Prior to that, it was the hardware. But it's interesting that now the ones that seem to have the stabilizing factor, and you can see it in particular companies, even like with Facebook, Meta. Meta is now starting to move toward the hardware side with the headsets and the whole metaverse and everything. And so that seems to be a bit of a trend. And it's just starting right now of that swing away from software and over into the hardware side.
Interesting. Okay, that of course is Kim Bolton. He's president and portfolio manager of Black Swan Dexteritas, taking your questions, as you just heard there, on technology stocks. So get those questions in. That phone number, 1-855-326-6266. And you can send by email to marketcall@bnnbloomberg.ca. Welcome back to Market Call. Kim Bolton is on our show today, and of course taking your questions on technology stocks. So Kim, let's get right to it. First up, we have an email. This is from Tom, and he says, could I get Kim's opinion on Matterport?
Thanks, Tom. We don't own it. We certainly follow it, but this is one of those sort of software as a service that has taken it on the chin. We've owned it before, but just for a brief while. So right now, it's down around $4. We actually have a the analysts across the space there have a 12-month price target of $5.82. So Matterport is all about digital twins. Digital twins are like avatars. You take an object and then you replicate it on your screen, and then you can sort of play around with it, make it more efficient, more effective. You can do it on actual objects like a machine to help it run more efficiently and more effectively. But you can also do it on environments like whole cities. So what Matterport does is they have an all-in-one 3D data platform. And they have the hardware, but they also have the software. So they have the hardware for the 3D platform, but then they also have the digital twins software platform that has AI and machine learning and so on involved in that. It's a very, very interesting company. It's sort of got brushed as a metaverse type play, but it's really not. It's a digital twin. However, it is unprofitable. You know, they don't have any debt. They do have some cash on the bottom sheet of cash, but on a diluted earnings per share of about in Q1 was 23 cents, but the non-GAAP loss was 10 cents. So, you know, these non-profitable software as a service type companies are really getting punished out there.
Yeah. Okay, let's get another email in. This one from Keith, and he asks, do you still believe Twilio has a dominant position going forward?
You know, I recommended Twilio in the past, if you go back over a year ago. You know, that whole software as a service really got punished back in February of 2021. That's when rates started to pop. We never really forgot that. And so at the end of come November and December of 2021, and it was obvious that there was going to be some quantitative tightening. They were going to get rid of actually the purchasing of all those bonds and mortgage-backed securities by the Fed and so on, and that interest rates were going to go up. So, and then you had inflation's the supply chain issues that came up. So we really got out of the way in December of all of these software stocks, even though I really like them, even though we still follow them. So like Twilio is really sort of, you know, the AWS of the communications world. It's the operating system for the digital world. And, you know, the story is great, but the problem is the underlying metrics. And in particular, the free cash flow. Profitability is a real concern. Without sustainable free cash flow, Twilio investors really need to ask themselves what they're investing in. Now, analysts are suggesting that Twilio's free cash flow profitability should improve as it seeks to achieve its non-GAAP operating profitability by 2023. But that's a year away. So I love the company. But it's just performed terrible and it's unprofitable.
Okay, let's head to the phone lines now. Our first caller of the day is Sandra out of Vancouver. Go ahead, Sandra.
Thanks for taking my call, Kim and Tara. So I bought Square Block, 60% off its highs a couple months ago, just to now watch it drop another 60%. And two questions. I'm wondering if Square, is it being fairly linked to the crypto price? And, you know, when will we see the Afterpay acquisition start to affect the stock? And the new idea that the iPhone is launching early access to using Square with the iPhone. So I'd love your opinion on it, because I'm got a lot of money in it. Thank you.
Yeah. I can feel your pain, Sandra. That whole sort of payment side has really, really struggled. It is so competitive. You know, you got the mega guys like the Visas and the MasterCard and so on. Then you had PayPal come in, you got Square. So it's become extremely competitive. But then on top of it, there's so much innovation going on in in the whole payment processing side. Somewhat here in North America, but especially over in Europe and the UK. Sandra, I'd suggest you look at a company called ADN, ADYEN. ADN is sort of the cutting edge of what's called real-time rails, and you'll be able to see what's going on in the, the transfer of money is constantly changing. There are issues when it comes to privacy and also effectiveness, but the real-time rails that are happening over in Europe, I think you're going to see come over here. So anyway, back to Square. It sounds like you don't want to get rid of it, so I'd actually write some calls against it to actually earn some income, to make some money, to actually bring down your average cost, if you don't want to get rid of it. But I think, Sandra, it would be a good idea to actually look at some of the new things that are coming on stream in the payment processing side. Now, to us, when we look, 5, 6, 7 years down the road, our grandkids are going to say, Pops, tell me about, when you used to have credit cards. So a lot of the legacy sort of payment processing guys are having problems. Square and PayPal do have the ability to innovate, but they're also going to need to acquire some of these real-time rail payments companies out there. Anyway, I could go on, Sandra. I hope that helps.
I can't wait for the day the kids are asking, what is a credit card? All right, that of course is Kim Bolton with Black Swan Dexteritas taking your question today on technology stocks. I'll give that phone number again, 1-855-326-6266. And there's some of the other ways you can reach him. Welcome back. Kim Bolton of Black Swan Dexteritas is taking your questions today on technology stocks. And we'll head right back to the phone lines. And we have Adele from Calgary. Go ahead, Adele.
Tara, thanks for taking my call. I always appreciate bringing such a knowledgeable and expertise on your show. For your guest, BlackBerry is going up and down like a yo-yo. And all the press releases the last few months positive towards the stocks, BlackBerry, and they're all positive, but it's not holding on and is not appreciated. So what's your opinion down the road on BlackBerry? Is it going to keep going down, or is it going to appreciate? Thank you.
Thanks, Adele. Well, I used to participate in BlackBerry, but I haven't for the better part of a couple of years. It's become a shadow of itself. They've innovated into the software side, but again, like I said before, the software side is very much in the penalty box. Even though their software is state of the art when it comes to automotive security and enhancements and so on. So I just think that there are a lot better opportunities, even on the software side, but particularly on the cybersecurity side, and in the secure web gateway like Zscaler, or even into the security information management side like Splunk, or even into the network security or security hygiene like a Palo Alto. Adele, I think there's just better opportunities with longer runways elsewhere than BlackBerry.
Okay. Now we have Frida from Chilliwack. Go ahead, Frida.
Yes, hello. I'm interested in your comparison of Amazon to Shopify and what you think the future holds for both or either one. Thank you so much.
Thanks, Frida. Well, we actually own both in the fund. We also have separately managed accounts that we have probably more Amazon than Shopify. But, Shopify has an extremely long runway going out, but as does Amazon. When you enter into uncertain times, though, I would much rather recommend one of the mega cap, like an Amazon, that actually has the ability, if we were to go into a recession, that's a big if, but they have a lot more defenses than that of Shopify. So that's why I'd be more skewed toward Amazon. Now, I could get into the financial metrics of both of them, but generally, that's what we feel. With Shopify in US dollars terms, trading down at 338 is an absolute bargain. But we have a small position. We have about probably a little less than 1%. But when it comes to Amazon, we have a 5%. It's in the top 5 of our holdings. Thanks, Frida.
We'll try squeeze in one more, and we have Peter in Vancouver. Go ahead, Peter.
Thank you, Tara. Tara, thank you very much for protecting the callers and asking your guests more details. Like he said, we are waiting for entry point. You ask him, what is your entry point? Thank you. And the great Kim Borden, the tech guru, how are you today? Send my regards to your
Good to hear your voice.
Please, may I have your expert opinion on this PLTR? Thank you very much, Kim, the tech guru.
Sorry, Peter, Tara. What was the stock that Peter was asking about?
Palantir?
Oh, Palantir. Okay. We got out of Palantir very begrudgingly, out of the fund. We have it in a couple of our separately managed accounts. Currently trading at $9.03. I remember last year when we used to have price targets, or the street had price targets of 12-month price targets up in the high 20s, but the average price target for Palantir is now $10.56. So it's not very long. They are without a doubt the leader when it comes to artificial intelligence. We have an analyst down in Silicon Valley, and as Yuri always tells us, you follow the smart people, and the smart people always attract smart people. And so Palantir is the king when it comes to having the smartest people in the artificial intelligence machine learning space, which is a massive space. However, a lot of these companies, like a Palantir, are not profitable. They have a great platform. They have 2 platforms. They have Gotham, and that's for the public space. They have a lot of military contracts around the world on artificial intelligence. And then the Foundry side of the business is more for the enterprise. Now, the total addressable market for artificial intelligence is $119 billion. However, it is years down the road to actually becoming a profitable business. A lot of the mega cap companies have a significant interest, but in artificial intelligence, but they also have revenue coming in from other places, and they can divert that into future revenue places like the artificial intelligence. So anyway, Peter, Palantir is a great company. It's very, very early. It will become a significant player in the technology arena, but it's still early.
Okay, that of course is Kim Bolton, or as Peter calls him, the tech guru. Stick with us. We'll be right back with his past picks. Welcome back. Kim Bolton of Black Swan Dexteritas is on the show today, and now it's time for his past picks. So first up, Kim, I should mention these are from August 4th, 2021. The first one, ServiceNow. At the time, $593.47. Now $450.68. So we're seeing a total loss on this name of about 24%.
What a difference a year makes, eh?
Yes.
So, you know, actually ServiceNow, it's down 24% from a year ago. And it's a software as a service company. It's very much a poster child of the software as a service. But, you know, elsewhere, if you look in the software as a service, big companies, even profitable companies, will be down 40, 50, 60%. So down 24%. Sounds ugly, but it's actually the prettiest girl in the crowd. And we actually have a 12-month price target. The street, has a 12-month price target of $625. So it's a long runway that it has. And if you're of the belief that, you know, come this time next year, that the Fed is actually going to dial back, rates will calm down, inflation will have calmed down, that, you know, the tech arena will be led by the likes of companies like ServiceNow. So ServiceNow, you know, they operate what's called their Now platform for workflow automation, artificial intelligence, machine learning, performance analytics, and so on. It's been around for a long time. It is profitable. It has 99% contract renewal rate. Very, very sticky customer business. It's generating free cash flow. You know, it trades at a premium to its tech peers, even though it's down over the course of the last 12 months. But it's generating cash. So I still very much like it. We own it.
Okay, let's get to your next one here. Upstart Holdings. So this one at the time, $127.98, now $38.20. So a total loss on this one of about 70%.
Yeah. Recommended it last August. We actually got out of this in December of last year, just because you could see the macro picture very, very much changing. And it has, right? You know, and even in its most recent earnings report, you know, they lowered their fiscal year 2022 guidance on lower expectations of borrowing demand because of the rising rate environment. So what Upstart does is that they actually have a software, and they sell it to banks and financial institutions to actually to lower their delinquency rates. And it's just a software that runs in behind. So anyway, we don't own it. The 12-month price target on this, even though it's trading around $35, is the analysts have a $51 price target.
Okay, and let's get to your last one here. Fiverr International, at the time, $230.58, now $33.60. So this one, a loss of about 85%.
Aye. You know, Tara, I remember August 4th because Fiverr International actually reported the next day. And they missed by a mile. They missed by so much that they should have come out with a warning in advance of their earnings report. And you know, we haven't gone back to look at them. So there is an Israeli company. We have an analyst actually in Israel, Alex, that brought it up. And basically Fiverr is an online platform that allows buyers and sellers to connect so that they can buy and sell digital services. You know, its name started because the price of its service initially started at $5. However, they're not profitable. Great story. Once again, a great story, but not profitable. And when you look under the hood at the financial metrics, it makes it very difficult to weigh back in.
Yeah, and you can see that drop back on August 4th. Okay, we're going to have to leave it right there. Of course, that's Kim Bolton. He's taking more of your questions on technology stocks right after the break. Stay with us. Canadian consumer inflation rose 7.7% year over year to its highest in 4 decades. The inflation gauge rose due to fuel prices, hotel rates, and cars being the largest contributors in May. Bank of Canada's Senior Deputy Governor Carolyn Rogers spoke on inflation at a Globe and Mail event and said the priority is containing domestic pressures.
We're already seeing some impact of rising rates. We are seeing a bit of a moderation, particularly in the housing market. I know that's something Canadians pay very close attention to. We do as well. The important thing now, though, is we have to contain the domestic pressures on inflation. And very importantly, we have to keep Canadians' expectations of future inflation anchored.
Meanwhile, U.S. Federal Reserve Chair Jerome Powell says the central bank anticipates that ongoing interest rate increases will be appropriate, and the Fed will need to be nimble in responding to incoming data and the evolving outlook. Powell made the comments in his opening remarks to the U.S. Senate's Banking Committee. When asked about fast, aggressive rate hikes possibly driving the U.S. into a recession, Powell said, given current global events, it's definitely a risk.
It's not our intended outcome at all, but it's certainly a possibility. And frankly, the events of the last few months around the world have made it more difficult for us to achieve what we want, which is 2% inflation and still a strong labor market.
The Parliamentary Budget Officer says federal government is facing a loss on its purchase of the Trans Mountain Pipeline. In an updated report, the PBO estimates a loss of $600 million. In the PBO's previous analysis, it estimated the government's investment was still profitable. However, since then, cost estimates have surged by nearly $20 billion. And we're going to take a quick look at the markets here. You can see the TSX Composite is under a little bit of pressure today, down more than 1%. We're seeing information technology, industrials, and consumer discretionary are trending higher, but the big ones, financials, materials, and especially energy, dragging us down. So with that, let's get right back to Kim Bolton of Black Swan Dexteritas and his questions that are coming in on technology stocks. So let's head right back to the phone lines, and we have Jimmy from Welland. Go ahead, Jimmy.
About Intel.
Jimmy, are you there?
Yes, hello.
Okay, Jimmy was going to ask about Intel. Oh, there you are, Jimmy.
Yeah, I'm here. I'm excited about Intel. Looking for your guidance. You seem to have a great filter and ability to really simplify complicated things. So if you could help us out with that, thank you very much, sir.
Thanks, Jimmy. Sorry, I'm just pulling it up. So Intel, we actually own INTC. There it is. So the whole semiconductor space, which Intel is part of, has really taken, it's come off a good 50 to 60%. We still own quite a few names within that, on the foundry side, like TSMC, Intel, on the manufacturing side, like a Micron, even on the equipment side. But we also, even though we like the names and we're unsure of the macro sort of headwinds that have happened so far this year, what we did to protect that space is we actually shorted the SOXX. So we stuck with our stock positions and we shorted the SOXX, which is the ETF, the biggest semiconductor ETF out there. So we have unrealized gains on the SOXX, and we have unrealized losses we've actually started to take profit on some of those gains on that SOX ETF. Now, Intel, Gessler, who is the guy that came in, I guess almost about a year ago. He came from VMware, which is that arm of Dell Technologies, and so he came in. He's a good management operator, but he's also an engineer, which is exactly what Intel needed to actually go out and really give that level of comfort to their investor base. So, to us, there's 5 reasons why we still own Intel, even though it's come down, it's down to about $37.50. So number 1, Intel's breadth of product line gives it a huge advantage going forward. Number 2, Intel has added to its capabilities via acquisition every year for the last 5 years. Intel is a free cash flow machine and very, very profitable. Number 4, Intel's enviable gross margin. Remember that Intel actually manufactures most of its chips. It does job out some of it to TSMC out of Taiwan. But having that internal capability to manufacture their own chips, they do grab a very healthy margin. And number 5, Intel is hands down a leader in the central processing units, CPUs, and also autonomous vehicle chips. And autonomous vehicle chips, that's the place to be. So, Jimmy, I hope that helps. So our 12-month price target on Intel is $56.
Okay, let's get to Rick from Calgary now. Rick, what's your question for Kim?
Good morning, and thank you for taking my call. I'm a small shareholder in the company Qualcomm, and I'd like your opinion on its future. Thank you.
Sorry, what was the name of the stock?
Qualcomm.
Oh, Qualcomm. I love it when people ask about companies that we own. So we have it in the fund. We also have it across a number of separately managed accounts. Currently trading just around $122. 12-month price target of $197.50. So it has a nice long runway. Qualcomm actually competes with Intel that we just talked about on those central processing units, which is really, it's the engine when it comes to digitalization and a lot of the technology arena. So there, it creates intellectual property, semiconductors, software, and associated services. But it also has another arm of it that actually competes against that and very well competes with NVIDIA, is in the graphic processing units. Now, Qualcomm has actually made a great name for itself in the leadership in 5G. And that's the big rollout that we've had over the last couple of years. So the last thing is that they acquired a company called Nuvia, Nuvia, and this really gives them a stronger entrance into current lines in the smartphone and the Windows PC, and also the automotive system on a chip. And so it just makes them a lot more competitive. So we like Qualcomm.
Sounds good. That, of course, is Kim Bolton with Black Swan Dexteritas. I'm afraid we have to take another break, but we'll get right back to your questions coming in on technology stocks. See you in a bit. Welcome back to Market Call. Kim Bolton is taking your questions on technology stocks. Kim, we have a lot of callers here, so let's start with Cynthia from Mississauga. Go ahead, Cynthia.
Hello, good day to you both. I'm interested on Kim's views on the ARC funds, such as ARC Innovation and the others. I got caught up in the rush to buy, and now they've lost so much. I have lost. So I'd like Kim's comments on the future of the ARC funds and what I should do. Thank you.
Thanks, Cynthia. Well, I guess Kathy Woods and the ARC funds are sort of the poster child when it comes to the pounding that the technology arena has taken this year. You know, we follow it. They're very aggressive, going after the innovators. I like talking about the ARC funds, Cynthia, because you know, there are bull markets and there are bear markets, and everyone should actually be able to hopefully profit in both bull and bear markets, or at least be able to weather if you have a long portfolio and you end up going into a bear market. You have to have the tools to actually weather that. And there are tools. You know, for example, on Canadian bank platforms, the discount side, you know, for the way that you can protect an ARC investment is by buying that PSQ. PSQ, it's the inverse of the triple Q, which is, you know, the large ETF out there. So you can short it and actually protect your investment from the long side. For us, what we do is that we use equity indices to actually protect our long stock portfolio in the technology arena. And it works like a charm. Like, yes, this year we are down year to date 7%, but that's very, very manageable versus, you know, the NASDAQ that is down 33%. And unfortunately, you know, ARC is down more than that, but you have to have your tools. So anyway, Cynthia, I would investigate or give us a call, and we can show you some of those tools to actually weather these bear markets and also protect your long investment. Thanks, Cynthia.
Some good advice. Okay, let's get to Wanda from Beamsville. Go ahead, Wanda.
Yes, I would like Ken's opinion on Nuvve and what they do.
Okay. Thanks, Wanda. You know, we follow them, we don't own them. My goodness, Nuvve. I guess if you go back to last fall, it was all the way up to about $175, and now here we are sitting just under $50. So it's off like 70% from its high. But you know, it's a big company, and they're, you know, they just went through a reporting period, and you know, management was extremely bullish on their business, and so Nuvve is participates in the e-commerce space, but it's just been brushed very much like Shopify. Gosh, you know, Shopify, it was up around 1,500 plus Canadian, and then now down around 400. So, you know, I'll go back, Wanda. If you're going to own some of these stocks in the technology arena, you do have to have the ability to defend those long positions. So I hope that helps, Wanda.
Sounds good. That, of course, Kim Bolton, Black Swan Dexteritas. He's been taking your questions this entire hour on technology stocks, but stick with us. His top picks are coming up right after the break. Welcome back to Market Call. Kim Bolton has been on the show this entire hour, taking your questions on tech stocks. I believe Peter called you the tech guru. So let's go to your top picks right now. First up, we have Apple. Why did you choose this name?
Tara, when I go through these, you're going to think I'm a little chicken little, taking the big guys. But But the three top picks that I have, we actually added to our positions earlier today. So we're putting our money where our mouth is. So Apple, we don't often get a chance to buy Apple on the cheap, and here it is, what, 135.70. Apple has such a long runway to price target. The average analyst out there has a 12-month price target of $190. And why does it have a long runway like that? Because it has a phenomenal economic moat around their business. They're extremely profitable. And as we've seen, they still keep the bar very high when it comes to innovation. And finally, the expected rate of return for Apple has been phenomenal over the years. So you don't often get a chance to actually buy it with such a long runway in front of it. Let me just sort of talk, they just went through the big WWDC 2022 conference, where Apple actually came out and talked about their new innovations. So they came out with Apple Pay in 4 options. They came out with the M2 enabled MacBook Air and the 13-inch MacBook Pros launch. They came out finally with their new M2 chip, which is really generational. They came out with more operating system updates. And finally, they came out with some CarPlay enhancements, which are really, really interesting. Enhancements to CarPlay, which integrate car systems directly into the CarPlay interface and so on. It's important when you look at these sort of services and that they keep bringing out these innovations, because, Apple's highest margins actually come from their services segment, not from their hardware, the handsets, the smartphones. It comes from the services. Their margin on the services side is 67%. So anyway, it's a great opportunity.
Okay, let's get to your next two. Another big name up here, Meta Platforms. And I do have to warn you, we have about a minute and a half for each of these next two. So go with Meta Platforms first.
Well, you probably think I'm crazy when I bring up Meta, because it's down like 50% from even back in February. But again, I think this is a great opportunity. Just think about it. This company reaches 3.6 billion monthly active users across all its platforms, and it has generated almost 3 billion family daily active people. That's phenomenal. With an estimated world population of 8 billion people, where 3 billion of them don't even have internet, to actually achieve 45% penetration is a tremendous achievement. Now, you got to monetize that, right? And they've had a problem on their software side. This is why they're looking at the virtual and augmented reality side with their headsets. So again, Tara, it's that swing away from software into the hardware side, and they're doing it. And you're getting it very, very cheap, down at $159, and it's got a 12-month price target at $277.
Oof. And there's that theme again, from software to hardware. That's interesting.
Yeah.
And let's get your last name in, Accenture. So on this one, we have about a minute left. Sorry here, Kim.
Oh, okay. So Accenture, they're a consulting company. They compete with the likes of like a Deloitte. But they're one of the biggest ones out there. One reason we really like these guys, because there is an off chance that we could go into a recession. If you actually go back and look at the performance of Accenture in the previous couple of recessions, back in the great financial crisis, or even back in 2000, they actually did reasonably well. And the reason for that even during challenging times, is that their clients are really sticky. The switching costs for their clients to actually go elsewhere is very, very difficult, because Accenture gets to know your company inside and out, if not better than you. So anyway, plus they have a yield of 1.4%. So anyway, currently trading around $275. I've got a 12-month price target of $415.
Yeah. Look at that. Okay, that of course is Kim Bolton. He's with Black Swan Dexteritas. He's been taking your questions this entire hour on technology stocks. So thank you for all of your time and expertise, Kim. And before we let you go, let's take a quick look at the markets. And we'll start with the U.S. markets. And they're looking okay today, holding on into the green there. You can see all of them just marginally so. But if we look at the TSX there, we are seeing us being pulled down quite a bit. We're down a little over, a little less than a 1% at this point. So while we are seeing some gains in some sectors, it's the big three that are really pulling us down: financials, materials, and in a big way, energy. So that's really having a big impact on our markets today. So stay tuned. John Ehrlichman and Bloomberg Markets are coming up right after the break. Thanks for watching.